2018 as a year for investment markets was a year of quite profound change. It's one where the appetite for risk and return moved from one of optimism in the early parts of the year, similar to previous years, to one of a much more cautious behaviour as we progress throughout the year. You know, the last 5 years have been, we've seen quite depressed levels of volatility. The last 2 quarters we've seen volatility really step up in markets. And what's driving this is post what has been a very productive and successful period for economies and markets post the global financial crisis, we're now starting to see some of these tailwinds turn into headwinds. Interest rates are starting to go up. Central banks are moving from a period of quantitative easing or providing liquidity into markets to a period of quantitative tightening where they're withdrawing liquidity for markets. And this is flowing through into asset prices in a market way. If we look at listed shares on a global basis, it was quite a strong middle section of the year for returns, and they were building quite nicely. That has been completely reversed in the last quarter of the year. So to a point where we now have listed shares on a local currency basis in negative territory across most markets. We've seen the technology sector in the US fall twice as much as the broader market. So some of the recent winners have become very significant losers in the last quarter. We've seen a lot of volatility in currency markets. So the US dollar's been a very, very strong performer and has rallied quite materially. We've seen things like the oil price pull back very, very sharply, and the underlying current that's driving a lot of this action in markets is about global growth and significantly the fear that the US economy, which has been performing very, very strongly, is maturing. The Federal Reserve has been raising rates, and are they doing too much of that? And with compounding with the uncertainty around trade wars, if they raise rates too far, is this going to push the US economy into recession? This is not our view at the moment. We think it's too early for that, but these are the fears that have been priced into markets, particularly in the latter part of 2018. We think there's a material change in the economic backdrop now, in that where we've previously had synchronised growth on a global basis, we're very much moving to a desynchronised opportunity set now. So the US economy is continuing to perform very, very strongly, and rates are going up there as a result of that. In Europe, it's much more sporadic, it's much more specific, and things like Brexit and uncertainty in the UK are having a pretty material impact on economies, but also capital allocation decisions by companies in those markets. We've got a slowing China. And that's to be expected, right? They're a big economy, they are slowing over time. The reality is it's very, very difficult to engineer a soft landing and a slowdown, and it's impacting emerging markets at the moment, and some of those growth rates are pulling back quite sharply. So the economic backdrop is very much different across the globe. The second thing is valuations. And what we've seen over recent years is, using equity markets as an example, valuations have moved materially higher since the global financial crisis. And as you know, we've actually been pulling risk back in these markets as valuations have moved higher. In the last quarter, when concerns have started to be priced more into markets, some valuations have moved back quite sharply. So international equities, domestic equities are now trading in line with long-run averages, which has meant we've seen this negative impact in equity markets. From here, things are looking more interesting, and we're going to get more volatility in markets. The risk for us in the near term is that equities actually trade at a bit of a discount to the long-run average in the near term, given there is still quite a bit of uncertainty around the globe, and we're navigating things like trade wars. So although we're starting to see some reasonable returns get priced back into equity markets, we're a bit cautious as in going too early. We think we're going to have a bit of time on our side. But I suppose the overall point of this is, in a whole range of markets, we're expecting returns are going to be somewhat lower than in previous years. And what will add to that will be our ability to be active on behalf of our investors in what we think are going to be more volatile markets. We feel the portfolios are very well positioned for the current market environment and well positioned to deliver returns in coming years. You recall that we actually have 3 broad buckets of assets within the portfolio. Preservers, which are really cash and cash type instruments. We have growth assets, which are predominantly equities, and then we have diversifying assets, which is part of our alternative strategy, and the idea of them is to diversify us away from equity market risk. We'd actually built the preserving and the diversifying assets to about 65% of the balanced portfolio. So this is quite a high allocation, and we expect that's going to provide the opportunity for us. Volatility, although we wouldn't openly welcome into portfolios, it does create an opportunity for us, and we shouldn't be scared of that. So as we sit today, we feel we're exceptionally well positioned with a bit of liquidity and some diversification in our portfolio that we can take advantage of what we think will be a more volatile market environment, including buying equities when they get cheap enough. We are late cycle in terms of investment markets, and we see that flowing through into various asset classes with mixed returns and in some cases negative returns. It's important to remember we're a diversified portfolio, so we're not just tied to equity market returns, which is really key. And irrespective of shorter term returns, both in portfolios and in markets, we're really confident about delivering the return objective over the appropriate time frame. We've done that in the past, and we're confident we can do that in the future. Where we sit today, we've got a lot of cash, we've got some diversifying assets, we've got a low allocation to things like equities, growth assets, and that's actually an opportunity for us. So a little bit of market volatility and our ability to be active in this environment will be really key in delivering returns.